Hello there, this is James, and you're about to watch the latest episode of our Primus live webinar series. It's about to start in literally about 3 minutes. I'm excited. I hope you're excited too. See you soon. Hello there, this is James, and you're watching Primus Live. And thank you and welcome for joining us. Now, before I introduce you to my very special co-host, now remember, these little episodes we do are for educational purposes only, and in no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence and know the risks at hand before entering any trade. Now, let me introduce you to my co-host. Really, she doesn't need that much of an introduction because you know her already, but her name is Kaya, and she's our head of investment research here at FXPRIMUS. She's worked as a portfolio and investment manager with exposure to both private and public markets. Before FXPRIMUS was so lucky to get her, she worked as a senior investment associate at a hedge fund in Singapore and was a vice president at Bank of America Merrill Lynch. Welcome, Kaya.
James, my friend, how are you? Good to see you.
How are you doing, my darling?
I'm doing great.
Oh, okay. I think are you muted? There's a bit of a problem with the sound, my darling. Can you check that?
Is there a bit of a problem? Let me just check that. Doing a quick audio check.
1 second.
Let's try this. Can you hear me better, James?
No, okay. Like I say, don't forget, ladies and gentlemen, these are live shows, and we sometimes have the occasional technical hiccup. I'd see if Michael can, our producer, fix the little problem.
Just testing, James. Is it better now? Is my audio fine? Nope.
Oh, okay. As we're waiting for that little technical hiccup, remember, these little educational shows are for your good people out there. And we always suggest, of course, that any topics you like us to cover in particular, any areas of interest you like us to discuss, please share that with us. Because at the end of the day, we are here for you. At the same time, please, please, please keep coming in with your questions. You have come in with quite a few questions recently, which is great. I think we're back. Kaya, are you okay?
Hi, James. How are you? Can you hear me? Nothing?
No, I still can't hear.
We're doing a test, doing a test, doing a test. Let's do a test. Video. Nothing? Okay.
Okay. Yeah, there's still a little bit of something there, not quite right. So Michael's going to be looking into it. Anyway, today's subject, here we go. Again.
Test again. Test again. How's my audio now, my friend? Nothing.
I can't hear you.
Hang on.
Okay.
Whoa. I've got you. I've got you. I can hear you.
Hi,
I can hear you.
James. How are you?
I'm great. How are you?
I'm doing great as well. So happy to be here. We have a bit of audio hiccup every now and then, but like James said, it's a live show, so these things happen.
It does. But like I say, you know, not being funny, of all the episodes we've done for quite a while, that's the very first time we've actually really experienced any issue. So anyway, how are you? How's things?
James, I'm doing great. I reflect back on our previous week's discussion about having very sort of tame markets and, you know, having a smooth ride. Everything was disrupted since. Those who actually monitor US equity markets knew that we had I would say a market event last week. Okay. And what I mean by market event is that there were actually trading halts applied for some of the names that trade in US stock market. And I'm referring to the same GameStop and AMC Entertainment situation.
Right, absolutely. The big headline, which has been almost everywhere, hasn't it?
It's been almost everywhere, and although the event itself didn't have that big impact, meaning we didn't lose billions of dollars, nobody went bankrupt. However, I do feel that this particular event is changing the mindset and the psychology of many market players. First of all, the retail investors, but also many of the institutional investors.
Yes.
What do you think? What's your take on this event?
Like I say, you know me, I always discuss one of my biggest, again, not that saying the Elliott wave theory comes into this, but I'm a big believer in like the Elliott wave when it comes to the madness of crowds, where something suddenly gets the attention of maybe somebody who isn't a trader or isn't an investor, and suddenly everybody starts sort of getting involved and, you know, getting involved in the markets where sometimes maybe they shouldn't be, if you know what I mean. And this is one of those sort of events when all of a sudden everybody got involved in it. And indeed, like I say, you can always tell when something like this is similar, or the whole madness of crowds theory is when stories like this start appearing in non-financial related media, when you're talking about tabloids. And this is one of the headlines which have really captured it. But like I say, it's a big discussion. And I think this special episode, we're going to go in a bit more detail about it, aren't we? In a special way.
We have to go into detail because there's no way to ignore this event. Like you said, it's been in the headlines in the financial media as well as in sort of more mainstream media. And what I found last week is that people that I haven't had a chat with for the last 2, 3, 4 years sort of reached out to me and was like, would you invest in GameStop? And I was like, oh, this is a good indicator that we have reached some sort of bubble here. I mean, the market was going bananas because of this GameStop. And I just want to give a bit of a background. What is this whole story about? And we have to take a bit of a step back and go into early 2020. And that was the time when this Reddit, which is a social platform, started getting attention, especially one subgroup called Wall Street Bets. And the reason being is that the members of that Wall Street bets started doing quite erratic trading. So they were buying shares of bankrupt companies such as Hertz, which we have discussed in our live, and also companies in distressed sectors such as airlines and names such as Boeing, and clearly companies that are not very strong fundamentally were getting a lot of interest from retail investors. But what happened at the time was that the smart money, meaning that the institutional investors, they just basically shrugged off the entire movement. They were like, yeah, let the retail do whatever they want to do. We don't really care, right? But at the back of lockdowns, people being home, maybe being a bit bored, not having access to gambling because a lot of the sports events have been cancelled, and then they had the mix of government stimulus coming in, so people actually had liquidity, and on top of that, a number of retail brokers, and just to name a few, would be Robinhood, for instance, or Interactive Brokers, or DD Ameritrade, have introduced zero-fee trading. Which means the main friction that retail investors have had so far, it's gone. So they have access to the market. They can trade as they please. Of course, some instruments have been blocked from the retail, but nevertheless, the main frictions are gone. And they have the access to information, which is, I find, the most critical piece. Almost all data is available either for free or you pay for it. And let's go now to January 2021. What we saw, I think it was probably a couple of weeks ago, suddenly GameStop, a company that is considered as giant business, it's a blockbuster for video games. Share price started going higher and higher. I think it was $25 or something to start with. And clearly everybody was completely, puzzled what's going on, until they found out it was the same Wall Street bets crowd. So they had identified not a value in that company, but a structural market loophole, I shall say. So in essence, the smart money had shorted GameStop and some other companies to the extent that it was impossible to cover that short on the market. So you had companies had gone short 140% of shares outstanding, which is, first of all, completely impossible, and secondly, it talks more about the excess leverage in the system. And the dumb money identified, oh, we have a structural problem. What if we all go and start buying that name? Because that will create a short squeeze, which means that smart money will either have to buy in order to cover their shorts, or they have to top up their short margin. So they started topping up their short margin to the extent that one of the hedge funds called Melvin Capital required $3 billion bailout.
So
that's a lot of money.
It is a lot of money. So it is a little case of sort of David against Goliath, then, do you think, in some ways?
It can be in a way. I mean, that's how people describe the situation. It's the David coming from the street. Again, the dumb money, which I find hilarious because a lot of these people are extremely intelligent. And identifying a gap that a lot of the institutional players had not identified, which is bizarre because you would assume that a hedge fund that has, let's say, 13 billion assets under management, such as Melvin Capital, they should have some sort of risk management system that picks up social media sentiment as well. And so sophisticated funds do that, like Citadels and Susquehannas. They have clearly some sort of algo that picks up what's happening social media. And for some reason, Melvin Capital didn't have that, or they decided to ignore. And they ended up having margin calls up to 200% of the short interest, which is, again, I mean, normally you would have to pay about 175 as a margin for shorting, but that particular was 200. They were bleeding cash. They were literally bleeding cash. And the culmination of this event was that the retail brokers had to stop trading. They said, we're not going to take any buy orders. Some also stopped sell orders for those certain names. And that caused massive havoc on the market. I mean, the rumors were coming in from every direction. Like, it was the hedge fund that demanded, retail brokers to stop trading. And it was Janet Yellen who sort of told the clearing houses that you have to put up brakes. And it was just wild, I would say, Thursday, Friday.
It was something else. I mean, I think, like I said, obviously we have Bloomberg constantly on in the background while we're doing our day-to-day our duties. And it's that story, and obviously the story of AMC dictated everything. And it is, in some ways, I guess you could try and romanticize it a little bit, like the David against the Goliath, the little guy against the big guy for a change, and the little guy winning. And interestingly enough, though, there was, I don't know if you saw it, there was an interview by Jordan Belfort, the infamous Wolf of Wall Street. And he pointed out that though this thing with the retail market is exciting for the retail market, it's nice for the little guys putting one up against the big guys. At the end of the day, the big guys, most of them will definitely be able to fight back in many ways. It's the little guys who, in the end of the day, if they're not careful, will end up getting seriously burnt. That's it's not something to play at, so to speak. It's something you need to go in with a good set of knowledge, and certainly a good, as we discussed in previous episodes, of course, a good obviously risk attitude as well. A good risk management program, definitely. So,
but a lot of the commentary around this event was that the retail traders did not go to earn profit. They went in to make a sort of statement.
Right.
A lot of them weren't afraid to actually lose money. They just wanted to make a point. And you saw a lot of social media. I wouldn't even say social media. I shall call them billionaires that have very strong social media presence stepping in, such as Elon Musk, and you had Mark Cuban, and you had Chamath. They were all sort of, chiming in and giving their views, and they were sort of taking the side of the retail investor just to, get back at Wall Street. But, unfortunately, like you said, it's often the retail that some may win, but a lot of them will lose a lot.
Yeah.
But go ahead.
But like I say, it's been, it's been a hell of a ride, though, hasn't it? Really, it's been incredibly fascinating story to watch, and has dictated the market in many, many ways. Do you think this is just the beginning, though? Do you think there's going to be other cases of this, or do you think now?
So one interesting data point I want to share with you at the back of this question is that in January, those most shorted stocks, which normally have more than 20% of short interest, again, note that GameStop is 140%, but if it exceeds 20%, it's considered to be under stress. They gained about 25% in January, which tells me that there's continuous inflow of capital or money into those names. Yeah. So I would say the situation definitely is not going to just disappear. I think that the institutional investors have to be much more mindful that retail actually keeps track of these things, and they will have to adjust their strategies accordingly. And actually, some of the hedge funds, such as Citron, said that they're not going to short sell anymore because they just don't want to go against such massive pool of people. And Wall Street Bets had 2.7 members. Early January, they have now 10 million members. Wow. So it's just unbelievable event. And like I said, all the rumor around that, I think the rumors were much bigger than the actual reality of the situation. The reality, the truth what happened is actually very boring and very dull.
Yeah, when you get it down to the mechanics of it, it's like I say, the media and the social media makes it almost like a romantic, the little guy against the big, but the mechanics of it is actually quite straightforward, isn't it?
Yes. And actually, we want to do a sort of special visual this time. We want to show you how the flows took place and why was there why the trading was basically halted. So if you give me 2 minutes, I will actually, let's say 30 seconds. I shall change my...
You'll go into the studio, our special magical room. Okay, I'll be timing you. Okay, excellent. Well, okay, so this is something a little bit different for this episode. And as we're waiting for Kaya to step into the magical TARDIS, remember, like I say, these little courses we do, these little live broadcasts are for your benefit. So please, like I always say, please keep the subjects, ideas coming in. Any areas you want us to cover in particular, be it technicals, be it fundamentals, please share that with us. Now, don't forget as well, we'll probably be running a poll very shortly. So anyway, I'll talk you a little bit about that in a minute. But anyway, Kaya, there you are. You're back.
Here I am with our lovely white whiteboard. Yeah. So what I want to explain is the flow, how U.S. equity settlements work, especially for retail trading. So let's just give you a bit of a visual. What happens? We have a bunch of retail investors. And most of our clients or our traders would sort of fall into this bracket. So these are those traders who don't have a institutional license. So you are called as the others, I would say, by the market sort of participants. When retail traders want to place orders, they would normally have a broker. So the flow goes sort of downstream. There is a broker. In this particular situation, the brokers were Robinhood mostly. Well, that's a bit too small, you can't see that, but I'm just going to put them in brackets here. So Robinhood is effectively a zero-fee retail broker. And how do they earn money? I apologize. And how they earn money effectively is on the spreads of trading, or they can do such thing as a payment for order flow. And this means that whatever flow they get from their retail, they pass on. And they pass on to somebody called a market maker, which is even better, even bigger broker. So we call these the market makers. Market makers are the big boys. So these are the guys who manage tens of billions, and they normally would have multiple business divisions. They would have securities division, who are actually the market makers, but they can also have asset management arm. And this is very important because in this case, Robinhood used a company called Citadel as their market maker. Citadel basically pays to Robinhood hundreds of millions of dollars in terms of revenue. And these guys, they pass the flow. What is their motivation to get their flow? What they do effectively, they settle the trades often internally. They don't even go to the market. They don't need to go to the marketplace because they have such an aggregate number of trades, they can just cross-settle. So Citadel is an interesting one because they said they command 27% of US equity volume and 43% of US retail flow. No, which means they dominate the retail space. They can, I can't say that they can decide whatever pricing they want to have. However, they have been fined quite a few times for not offering the best execution for these guys.
Got you. Okay.
So you would say that there's a bit of a conflict of interest every now and then. It has been discussed. It's currently at the Senate as well. I mean, the Congress has brought up the topic, like, is there really the interest of the retail investors, represented? But the discussion hasn't really moved forward. Anyway, let's say market maker does not have enough opposing trades to settle everything. What they have to do, they will go to the market. So here is the market itself. We call it the market. See, I can't even spell market. The exchange. However, somebody has to keep track of all this, right? So there's always a central clearing party, which is called, in this situation, DTCC. So they sit sort of in between. They keep track of all these trades. And what is their function is to make sure that there is enough liquidity and they mitigate the counterparty risk. So let's say that I think a stock is going to go down. So I'm going to short the stock. James is going to be my counterparty. James says it's going to go higher. So we have sort of opposing views. And the TTCC is going to say, Kaija, just in case you are wrong, you have to give me 20% of the value. You have to keep it as a cash. You have to make that payment to me. So I make the payment, but what if the equity value goes higher? The rate goes against me. Then the DTCC is going to come to me and say, Kaija, you need to top up your collateral. Instead of 20, I want to have 40% now. And so whilst the GameStop share price, I mean, first of all, it gained 1,625% during January. While it was going higher and higher and higher, DTCC realized that those guys who were short, and these happen to be, again, those big hedge funds, right? So let's say there's another sort of flow here, hedge funds, started asking collateral, guys, you have to top up, but also these guys have to top up. The Robinhood guys had to top up. And it came to a point whereby a broker such as Robinhood said, we don't have cash anymore to top up. So we have to put trading to a stop now. And DTCC said, okay, fine, we don't accept any more trades. for these particular names, for these particular brokers, until you have topped out. And this is extremely boring, extremely dull process. And this is what's happening at the big institutions every day. So basically the payments between these guys happen multiple times per day. The payment between these guys can also happen multiple times per day. Depends on the volatility, depends on the market sentiment, depends on market movement. So the key sort of input for this is actually the volatility itself. So they use a VAR, value at risk type of models, in order to assess what is the exposure per counterparty.
Absolutely.
So this is what happens.
Exactly. So like I say, Robinhood has had a really bad rap for this. They would like sort of pointed out by social media, but being evil, you're stopping the people from, making money. How you're a pawn of the big corporations. But in fact, like you rightfully said, this sort of thing does happen throughout the industry, regular time, when you have any sort of volatility. Turkish lira, for example, things of this sort of nature. That happens all the time with all sorts of asset classes. It's just the fact that this particular story has caught so much attention of the social media that Robinhood, named after a hero, end up being painted as a villain. See how I did that?
100%. And it didn't help that Robinhood's CEO, Vlad Tenev, did not come across particularly trustworthy in most of the interviews. So to be honest, it was a PR disaster. That is the only way I would describe that. But Interactive Brokers, Mr. Pederfi, he actually chimed in, I think, last Thursday, giving exactly the same explanation. It's saying that it's not our decision. It's the central clearing party telling us you have to stop trading. And I think that was the one that sort of put the market more on sort of calmer mood, and everybody started, just de-leveraging and de-risking. And the moment this happened, when the holds were put on, I would say the de-risking started taking place across the industry. And you saw US equity markets actually down on Thursday, and I believe on Friday as well, at the back of DTCC, just identifying market risk being a bit higher, asking more collateral, and to give a bit of, quantum as well. From Thursday to Friday, the industry-wide collateral increased from 26 billion to 33.5 billion. So imagine being a Robinhood and saying, hey, we need 1 billion by tomorrow. It's very hard to meet that collateral requirement. And Robinhood actually was able to raise 1 billion overnight, and they have managed to get another 2.2 billion over the weekend. So I think from the perspective of liquidity, they should have enough.
Yes.
From the perspective, do people actually want to trade with them going forward? I don't think so. I don't think so, Case.
Okay, well, like I say, there we go. It's a very simple, it's very boring, it's very industry basic. Look, obviously, if you're not in the industry, you might not necessarily know the flow of how things work. But that is quite a really straightforward and a brilliant explanation of what really happened. And like I say, it's interesting to see what will happen to Robinhood with this misunderstanding.
Yeah, they were really at the forefront of this whole thing. And again, when we talk about speculation, one of the key speculations, which I'm just going to discuss here because it's so interesting, at least, I find it interesting, is that the same market maker, Citadel, right? So they have the securities division, who was effectively the market maker, facing Robinhood. They paid Robinhood for their order flow. At the same time, their asset management arm, the hedge fund side, which is also called Citadel, but they have, I'm sure it's some sort of asset management or some sort of, they were short, actually, the GameStop. So Citadel, that as a corporation, had two conflicts here. First of all, the clients of Robinhood were long, but they themselves were short. So the main speculation was that these guys went to Robinhood and said, you have to stop trading. And Congress, the Senate in particular, has started investigation on this already. So we will continue to see developments on this entire situation.
Okay. So like I said, like I say, this is like a stand. This is how the flow, and this has happened to many financial institutions before because of volatility. There is also maybe a slightly darker side to it, which we might find out more to come.
Yeah, and those who are familiar with 2008 crisis, this is effectively that bankrupt Lehman Brothers. This situation that they just didn't have liquidity at some point anymore. They had enough assets. They were, in terms of positions, balance sheet, huge bank. But what happened was that at some point they were saying, you need to give us cash because we can't. We have a feeling you can't honor the trades anymore, and they didn't have any liquidity. So lights were turned off, and that's party over.
Well, there we go. So that's the story of GameStop and Robinhood. Brilliant. Yes. That's fantastic. Fantastic, Kaya. Right. Do you want to come back to the normal studio now and leave the magical board?
I shall come back.
Okay, brilliant. See you in about 10 seconds and counting. Okay, so we're waiting for Kaya to come back to the plain, boring studio now. As I was saying previously, before when I was waiting for Kaya, we will be doing a panel or a poll soon on certain areas of what you think of this webinar series so far, what sort of areas you like us to cover, how long you like us to do these broadcasts for. So please look out for it, and when you do see it, please be honest and share good, honest feedback with us. Kaya, you're back.
I'm back.
There you go. Brilliant. So let's move on to the quick topic of the day, which is timeframes.
Yes, as always, our market update takes a bit longer than expected. As James mentioned, please look out for the poll tomorrow, so we actually would know whether you're interested in these type of topics or whether we should, spin them off to another sort of live streams. But today we're going to talk about time frame analysis, and this is coming directly from you, the viewers. We have had a lot of questions about how to choose time frame and how to trade those different time frames. So we have put together a pretty light, presentation type of discussion, just to go through the main points. So when we talk about time frame analysis or choosing a time frame, I would always say that the paramount thing is to decide what is the instrument or the pair that you are trading. And that ties back to our discussion last week when we discussed exotics versus majors. So for instance, if you do trade an exotic pair, let's say you go for Sing dollar versus USD, there's you can't really go for let's say a day trading, because Sing dollar does not have the liquidity to be available for day trading. So if you want to go for the exotics, you always have to go for slightly longer term. Whereas if you trade the main pairs, the majors, euro dollar, I don't know, pound dollar, whatever pair. Go for the 15-minute chart. Really go for the shorter time frame. Should you choose that? Also, the trading style. Are you a contrarian? Are you going to go for the momentum trading? What is the style that you like? So my personal view is, and James, you can chime in, that if you do momentum trading, you can really do shorter time frames. If you're going to do contrarian positions and say you add some sort of fundamental angle or some sort of macro angle, you should go for the longer time frame. Yeah, absolutely. Because again, that fits the two very different trading styles, isn't it, as well? In that, as in like more short-term trading to opposed to long-term trading. And I think we're going to discuss that in a bit more detail in the next slide. But yeah, I totally agree with you. Really, like I say, considering timeframes is really got to fit the sort of trading style you want to use or who you are as a trader. Very much so. Then, of course, critical part, how much time do you want to spend on trading? So those who choose to be a day trader, who have full time, looking at the screens, by all means, choose the shorter time frame. Personally, for me, I want to look at my charts once a day. I mean, my trading charts. I don't want to spend too much time on it because there's so much else to do in life. So I choose to go for daily charts, and I combine that with 4-hour charts for entries, and I look at the weekly charts for the trends. So it's always a combination of sort of multiple time frames. However, the longer the time frame, most likely the less you actually have to spend on looking at the screens. And I can't, I have to mention the aspect of stress tolerance / psychology as well. So if you are a bit more on the, I don't know what's a good word. If you're the person who hasn't gotten into the flow yet, if you haven't gotten the level 5 of the trader's development, maybe you are better off choosing slightly longer time frame, because you don't really see those movements happening that fast. Whereas if you're really comfortable and you are let's say, confident in your skill and your ability to read candlesticks and read patterns, then you can always go for the shorter time frame. So you can go for the 15-minute, maybe an hour chart or 4-hour chart.
Yeah, I actually think this is probably one of the most important things, actually, when deciding what time frame. Because again, this all fits into what type of trader you are. And like I say, if you're easily stressed and all that, then you're rightfully said, you are best to look at longer time frames. If you like the stress, if you like the excitement, if you like the thrill of the market movements, then obviously shorter time frames fits into more of your personality. So understanding your stress tolerance and what makes you you, I think, is one of the key things, or should be the key parts of one of your decision making in what sort of time frame you should look at. So I totally agree with you. And again, we've covered this again in the psychology of trading quite a bit, haven't we?
Yes, I mean, we have discussed the different levels of not to say sophistication, but I shall say the depth of the skill. So again, but at the same time, I've seen plenty of traders who are expert when it comes to trading different time frames, yet they choose go for the longer one because they just feel like it's easier to assess, and a lot of them do add some sort of fundamental / macro angle to their positions. So, and just to give you an example, let's say if you are a contrarian trader, let's say you want to trade against the trend, maybe based on announcements, maybe based on not even an announcement, but let's just say certain developments in the market. Let's say you have a strong view that the oil is going to go down. It's going to go back to, I don't know, $20 or something. Most likely you would not trade that on a daily chart. Most likely you would go and maybe choose weekly chart, maybe even monthly chart, and trade based on that. And perhaps you're going to choose your entry point based on a daily chart. Most likely you wouldn't go any shorter time frame if you talk about, let's say, month plus trades. Entry would be more or less on a daily chart. But we have a table actually we put together to just sort of list those the trends versus the entry and exit. And this is by no means a rule. This is just convention, I shall say, or how it's normally done.
It's the standard. It's the standard. It's a standard thing. Yeah.
So the way the long-term traders normally do or look at their charts, it's the trend they would go for the weekly or the monthly, and their exit and entry would be on a daily chart. And that's the type of, that is my categorization. That's what I do. For me, daily chart show me, am I going to enter the trade or not? But if I want to see if this thesis actually is valid, I would look at the weekly chart and also the monthly chart. When it comes to currencies, I find you can't get away from monthly charts, extremely important. But again, for let's say slightly more exotic instruments, maybe such as equities, options on equities, monthly chart maybe not that relevant. I would rather go for the weekly one because options tend to go up and down a lot, so they're quite volatile. And the trade itself, I mean, for me, the position is on for a day, up to 2 weeks sometimes. But yeah, generally it's day to a week.
Yeah, obviously long-term traders, position trading, which could even go longer than a week, is obviously can be months.
It can, of course,
It's for position traders. And then obviously you have these swing traders, which are a bit more medium term, aren't they?
Yes, swing traders are those who have slightly more time to look at their computer screen. The trade normally is on for, let's say, 4 hours, which is considered sort of as half a day. So I know, for currencies, you don't really have the day concept as such. But generally, let's say 4 hours up to a few days, so 2-3 days. Your trend is on the daily chart, but your exit and entry are on the 4-hour chart.
Yes.
So again, if you do the trend analysis, you can go slightly longer. You can just check what's happening on the weekly chart as well. And also for the entry and exit, you can always go lower. I mean, you can go for the hourly chart, but I would never check too many time frames because it's just confusing. And human brains cannot take in too much information. We have to be selective.
Yeah, we get confused otherwise, bless us.
We get confused, So I go for 3 frames, I would say. If I trade based on daily, I would check the weekly, and I would give a quick look on the 4-hour as well. So I go one up and one down, and I trade based on the middle one. And for the day trader, Oh, I see trader double there. I apologize. So day trader. Normally the trade is on for less than a day. And the trend is seen on the 4-hour chart, but your exit and entry goes for the 1-hour chart.
Got you.
And these are those traders who have to be pretty much hands-on. I mean, you can't go away from your computer for too long. You have to keep an eye. You have to have, I mean, for these type of trades, risk management critical, stop loss critical, profit taking critical. The long-term traders have a bit of more flexibility. They have that, I would say, that the cushion, because the movements don't happen that fast. But you have to check positions every day. Whereas for day traders, swing traders, at least you have to have stop loss. That's the bare minimum.
Yeah.
And then you have this special category called the scalpers. So I find scalpers to be, I don't know what's a good word for that. I'm always impressed by people who can just take in information that fast and act on it pretty much immediately. Yeah. I'm not that person.
Let me say, scalpers are a different breed of trader, because they really do rely on the excitement, and sort of, you know, really have the ability and the complete discipline as well to just jump in and jump out and really sort of snatch little profits, or, you know, take little losses. It takes an awful lot of discipline to be a scalper, and like I say, you have to really have plenty of time to be looking at your charts constantly. So it is a particular discipline, which not everybody has that sort of ability, or that sort of discipline for that type of trading.
To be honest, I find this extremely exhausting trading style as well, or you know, because I find my brain is already quite exhausted after doing 2-3 hours of proper trading from long-term perspective. So I can't imagine what it feels like actually sitting at the computer for 8 hours and you know, trading constantly. However, of course, you know, traders who do focus on very short time frames, they don't do it for 8 hours in a row. They do it maybe 2 hours a break, 2 hours break, and you know, they sort of you know, spread it out a bit more evenly. But yeah, I mean, it really depends on the personality. And you can be successful in each of these strategies. Although, of course, the gains are expected to be slightly higher if you go for the longer one.
Yeah, that's the point of a position trader, is obviously you hold the trade for a long period of time, because you have your idea where you think the particular asset's going to go over a length of time. So yeah, your overall profit target will be a lot larger. Whereas opposed to a scalper, like we've already said, you get in the market very, very quickly, and you take small profits, small profits, small profits, small profits, at the same time taking small losses, small losses, small losses, with the idea hopefully that the small profits will add up to a reasonably good profit margin at the end. So yeah, so it's different styles, different sort of targets at the end of the day.
Yes. James, I see we have some questions.
Excellent. Sweet. We had a couple of questions which were already sent in pre-show. So which again is related to timeframes, which is really, really good. And again, I think the first question, which I think we've already sort of answered, which is the best time frame should a trader enter or exit? And we discussed that on the previous slide. Again, it does really depend, as we've already said, on your trading style. You know, what sort of trader you are and who you are as a person as well, because obviously that goes in lines with your trader. The other question I have here, and this is again interesting, what is the best time frame for a beginner to successfully trade with? And I think you've already answered that previously.
I think my recommendation is go for the longer time frames. Of course, it doesn't hurt if you're practicing, if you have time, not to be the scalper, but maybe to be a day trader every now and then. But I think it's just easier to be comfortable with slightly longer time frame. So I think looking at the daily chart and you know, trend on the weekly, it's good way how to ease into the process, because nothing will happen too suddenly and too you know, out of the blue movement. But again, if you consider that, you know, it's the exposure that makes you a master. You have to do 10,000 hours of something in order to become really, really good. So I find, you know, trading shorter time frame compresses sort of the experience. So everything comes faster, the good and the bad. So if you're ready for that mentally, try trading the 4-hour charts, but also practice on the daily charts.
So, like I say, I would suggest the same as well, because obviously it's still noisy, but it's less noisy, and you can sort of not get carried away so quickly with the sudden quick movements, can't you? So yeah, answer the question. Time frame for beginners: start off with the slightly longer time frames as you adapt and as you learn, and you get more confident in your trading ability. The other question is how to ensure that I'm not entering the trade against the trend, and which time frames have more opportunities.
How to ensure you don't go against the trend. You look at your trend indicators, you look at your momentum indicators such as moving averages, you look at the RSI, you look at the stochastic, make sure you don't go against the trend to start with. And what is the most profitable? There's no such thing. There's no such thing as more profitable. It really depends on the skill of the trader.
Exactly. And I think, again, like I say, time frames should be dictated to what type of trader you are. Who you are as a person, who you are, what your overall goal is, and where you are, obviously, in your trading journey as well. So, yeah. Okay, as we wait for a couple of more questions, lovely people, please keep them coming. Kaya, do you want to discuss what we got coming up in the future? What other episodes we got coming up soon?
Yes, first of all, I'm going to mention again, we have a poll coming up on our Instagram. So those who are on Instagram, please go and find us. Our handle is FXPRIMUS. It's going to be part of our story, I think, tomorrow. And we're going to ask a few questions. First of all, we want to know the topics that we should cover. We're going to ask, what is the timing of these lives? Are you happy with doing it at this particular time, which is 3 p.m. GMT? Do you want us to bring more people in? We've had Riyadi ones, which got a lot of really good feedback, and we may have a surprise guest next week as well.
I definitely think we have, actually. We'll definitely have a special guest.
Oh, I'm quite excited about that.
Me too.
Yeah. So please do make an effort to go to Instagram and give us some feedback. But next week we are going to talk about candlesticks once again. We've covered this topic once before. On a very high level. So this time what we want to do, we want to really go into the weeds. We want to show you on the chart what do candles look like, how to use them. And I know that our potential special guest or confirmed special guest is an expert on that. So he will be the best person to show his charts and explain how he uses that. Then the following week, we're going to have patterns, again, the second part. And we're going to talk about the recognizing patterns on the charts. We're going to show you charts with the patterns and give a bit of visual side of it, how to see a cup and a handle, how to find a ascending wedge and all these things. And then we have planned doing actually a second episode for time frame analysis as well. Not sure if that's going to happen in 3 weeks, or we're going to postpone that potentially. And again, we try to incorporate any huge market events into our lives, and assuming nothing major happens, we're going to continue with our plan. And the correlation, which has gotten so many questions, James, something you mentioned last week. We have to go live on that.
Yeah, that's very true, because we talked a little bit about obviously when we were talking about currency pairs, we brought up positive correlations and negative correlations, and I talked about in particular the euro, sterling, and the guppy trade I used to do. So yeah, correlations, absolutely, we definitely need to do that subject, because it's a subject I'm quite keen on. I think one of the feedbacks I had, maybe an episode we might do the following month, is trend lines. That's popped up a couple of times, so I think we might look into doing that. Okie dokie. Well, we have no questions currently as it stands, so I think obviously everybody we've already assisted everyone. So probably they save their questions till next time. On that note, guys, please don't forget, without your feedback, without your questions, without your subjects, we have no show without you. So please look out for that poll. Your comments, your feedback, and your opinion on what areas or what you want us to do in the future is so important to us and our Primus Live webinar series. Don't forget you're watching this on Facebook as well. So if you liked it, click the like, I guess. And if you want to spread the word, please share. On that note, Kaya, would you like to say goodbye?
Thank you, everyone, for joining. We'll see you next Wednesday.
Absolutely. And as I always say, don't forget, These little live shows of ours are for educational purposes only, and in no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence and know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.